Hi, and welcome back. Professor Morgan-Nance here again. In this short set of videos, we will finish our discussion about the balance sheet by focusing on stockholders' equity. We will cover a number of topics, including how to record capital stock transactions and dividend transactions, and how companies really report stockholder equity to their users. You may have encountered this bit of trivia elsewhere in your studies. Corporations are considered to be persons by our tax law. Specifically, corporations are entities created by law that exist separately from their owners and have many of the same rights and privileges as individuals. As you know, corporations may be privately or publicly owned. Publicly owned corporations have additional reporting responsibilities beyond those of privately held corporations. For further details, please refer to your textbook. The corporate form of organization has several advantages. The major advantage is the ease of raising large amounts of money because both large and small investors can participate in corporate ownership. It's simple to become an owner of corporate shares of stock, and it is just as simple to transfer or to sell shares. A corporation's life continues indefinitely because it's not tied to the physical lives of its owners. Shareholders are liable for neither corporate acts or for corporate debt. Corporate creditors cannot make claims on the personal assets of shareholders to satisfy corporate debt. This limited liability characteristic is quite attractive compared to a sole proprietorship or general partnership, where the owners may lose their personal assets if the company is sued or files for bankruptcy. As noted a moment ago, the corporation is a separate legal entity that can enter into contracts, own assets, incur liabilities, and sue and be sued. The corporation continues in existence even when ownership changes. It has a continuous life. Now, two key disadvantages of the corporate form of organization include all the extra governmental regulations imposed on corporations and corporate taxation of earnings. Corporations pay taxes on their earnings, and then, if they distribute a dividend to stockholders, the stockholders also pay taxes on the dividends received. So the same income is taxed twice. You may have heard this referred to as double taxation. A corporation is created by obtaining a corporate charter or articles of incorporation, as is required in California, from a state government. Ultimate control of a corporation rests with the stockholders who elect the board of directors. In turn, the members of the board of directors hire the executive officers, such as the president, vice president, etc. And finally, the officers of the corporation empower others to hire all needed employees. So officers and employees and members of the board of directors may also be owners of the corporation. You already are familiar with the account names, common stock, and retained earnings, so you have already gained some understanding about stockholders' equity. Let's look a bit more carefully at the details. In general, corporations have two primary sources of equity, and both have normal credit balances. The first is called paid-in capital. Paid-in capital represents the amounts that the shareholders have invested in cash or in other assets by buying shares of capital stock from the company. The second source of equity is retained earnings. Retained earnings account reports the cumulative amount of net income the company has earned since its organization, less the cumulative amount of dividends declared since organization. This is the portion of net income that's been reinvested in the business rather than distributed to owners in dividends. As mentioned a moment ago, companies raise capital from their shareholders by issuing capital stock. The items on this slide are a summary of what we will be discussing in the remainder of the video. Before we learn how to account for equity transactions, there are several terms related to stock that we need to understand. Authorized shares are the maximum number of shares of stock that can be issued to the public. The number of authorized shares is identified in the corporate charter or articles of incorporation that is issued by the state. Authorized shares can be classified as either issued or unissued. Issued shares are authorized shares of stock that have been distributed to the stockholders. Unissued shares are authorized shares of stock that have never been issued to stockholders. Issued shares can further be classified as either outstanding shares or treasury shares. Once sold, a share will always be issued, but it might not be outstanding. Outstanding shares are shares that are currently owned by shareholders. And finally, treasury shares are shares that were once owned by stockholders, but the corporation repurchased the shares in the stock market. Now the corporation is the owner of those shares. And treasury shares reduce total stockholders' equity. They're a contra equity account. Corporations must disclose information in the financial statements related to their stock, such as par value and the number of shares authorized and issued. This slide represents a portion of the stockholders' equity section of the balance sheet. The word authorized with regards to stock means the number of shares that a corporation is allowed by its corporate rules, its charter, to sell or to issue. Think of this as the total number of shares of stock a company can sell if it chooses to. No formal journal entry is required for stock authorization. Simply speaking, the number of shares issued means the number of shares the corporation has decided to issue or to sell. And there is a third term called stock outstanding. And again, this term means the number of shares still in the hands of stockholders. More about that in a minute when we talk about treasury stock. In our example, notice that this common stock has a par value of a penny a share, and as a result, the company multiplies the par value times 92 plus million shares issued and outstanding to equal the amount reported as common stock on its balance sheet. As a side note, a corporation must apply to the state for a change in its charter if it wishes to issue more shares than previously authorized. Now let's talk more about the meaning of par value. Common stock often has a par value, which is usually a very small amount, such as 1 cent per share. Par value is an arbitrary amount assigned to each share of stock by the corporation in its corporate charter when the stock is authorized by the state in which the company incorporates. Par value is required by some states, but not by others. That is why some companies record their stock using stated value rather than par value. We will not discuss the legalities any further, although you may read more in your textbook. Finally, par, stated, and no par stock values have absolutely no relationship to the market price per share. Please make a note of that. No relationship to market price. Let's look at issuing par value stock for cash and other non-cash assets here next. Let's consider how we will record stock when issued. When the par value stock is sold for cash, the common stock account is credited for the par value of the stock sold. Remember that par value and market value are not related. The difference between the par value of the stock and the market value of the stock is credited to the paid-in capital in excess of par account. If you add together the amount of the par value of the common stock account and the amount in paid-in capital in excess of par common stock, you would have the market value of the sale of stock. In this example, the stock was sold for a premium. An extra $2 per share was received on each share in the marketplace. Don't get the word premium with regard to stock confused with the word premium with regard to bonds. They're a different animal. The premium is reported here as part of equity. It's not revenue. Let's record the entry then for Dillon Snowboards for the issue of 30,000 shares of $10 par value stock for $12 per share in cash. Dillon would debit cash for the market value of the stock sold, 30,000 shares times $12 per share. Dillon would credit common stock for the par value of the shares sold, 30,000 shares times $10 a share, and they would credit paid-in capital in excess of par value, common stock, for the excess of the market value over par, 100,000 shares times $2 per share. The paid-in capital in excess of par value account is added to the par value of the stock account in the equity section on the balance sheet shown on this slide. Notice how common stock is always reported in its own account at the par or stated value, and paid-in capital in excess of par is reported in a different account. A similar situation occurs when the par value of stock is exchanged for non-cash assets. This is a common occurrence in privately held corporations where the owner might contribute land, equipment, or other assets in addition to cash to get the company started. The corporation records the assets received at their market values as of the date of the transaction. In the case where the shareholder puts land into corporation in exchange for stock, the common stock account is credited for the par value of the stock issued. The difference between the par value of the stock and the market value of the assets is credited to paid-in capital in excess of par common stock. If you added together the par value of the common stock account and the amount in paid-in capital in excess of par common stock, you would have the market value of the assets received. Our example shows the entry to record the issue of 4,000 shares of $20 par value stock for land valued at $105,000. The important point here is that an asset is received by the corporation, that the common stock account is credited for par value, and any excess is credited to the paid-in capital in excess of par account. Let's take a short break.